Happy Friday and welcome to the National Real Estate Cafe from Greece. That's right.
Well, I wish we were in Greece, Don. It's a very, very tough time there. They're going through some difficulties that they've been going through for the last few years.
And it's really a precursor of what's going on in the market. So today we're going to wrap up the week real quick and give you an idea of what's affecting the markets today. And of course, Greece is one of them. We're waiting to see, are they going to handle their last, 17th bailout or whatever? Basically, they can't figure out how to make enough income to handle their debts. So we're going to see how that plays out. So we'll be watching Greece quite a bit.
Yeah, the markets are watching Greece, and that's why we will too.
So locally, I guess in America, we watch GDP a lot, and we're actually having a little problem with our own income, huh?
Yeah, well, this is interesting to see GDP be this low when we see a lot of other great indicators that everybody's spending. So how could GDP be this low? Maybe military spending? We have to dig into this report a little further to get more information.
Well, and you can see by the chart, it looks like, basically a California Richter scale report, up and down. But one report does not make a trend. And we'll see what the next ones, how they play out. But as Gino said, here's what's really happening is personal spending is up. And we can see it quite a bit with either the housing market, the auto industry, and so much more. So that could be a precursor to possible inflation. We know the housing market's on fire.
Yeah, so if you see personal spending because people have confidence, and here's the reason they have confidence, Don.
This jobless report, we used to talk about this a lot. Now it's been a flat line. Not really a factor, but maybe it's not a factor because that's what's giving everybody confidence. Not as many people filing for unemployment, but the jobs that are coming out, maybe not as strong as we would like, meaning income growth.
Yeah, so let's look at a couple of things here. So if we've got personal spending is up, it's a precursor to inflation being up, people letting go is being lower, so confidence is going to come in high. So even if GDP is not good, we do have a recipe for GDP to be good coming soon.
Right. So all these factors are slowly making rates increase. We've been telling you that for months. That rates are going to be inching up, and they've gone up about 0.5% since their lows when they were in the 3s and now in the low 4s. Still great. Time to take action because we feel that rates are going to continue to inch their way up. We may have a couple of little spikes down, but take action now because, as Gino likes to say, rates affect your cost more than the sell price of the home. So
yeah, you've got two things to look at here. One is I think interest rates are going to be 0.25% higher by the end of the year. If they are, don't be faked into thinking that the prices are going to go down. For the last 4 times when interest rates rose, so did prices.
No doubt about that. In fact, stay tuned next week. We're going to talk more about that. You have a great weekend. Thank you for tuning in to the National Real Estate Cafe. If you want to get this on your phone daily, text NREC, that's NREC, to 58885. To 58885. Check us out at nrecafe.com. Have a great weekend.